A gallon of milk cost you $3.49 in January 2021. Today, it costs $4.15. Your car insurance was $130 a month 3 years ago. Now it's $210. That coffee you grab every morning? $3.25 then, $4.50 now. Your landlord just raised rent from $1,800 to $2,100 a month. Same apartment, same broken dishwasher, but here's the part that'll make you question reality. Open your savings account statement right now. See that number? $47,000. Same number that was sitting there 2 years ago. You've been saving, you've been responsible, you did everything the financial advisors told you to do, and you've been robbed. Not by a guy in a ski mask, not by some Nigerian prince email scam. By your own government, using a mechanism so mathematically precise, so systematically deployed, that most people retire before they realize what happened to them. When did saving money become a guaranteed way to lose money? I'm going to explain exactly how financial repression works, why the US debt situation makes it mathematically inevitable, and what you can do about it before the next phase kicks in. This isn't some conspiracy rant. This is pattern recognition using the exact playbook the United States deployed after World War II to eliminate a debt to GDP ratio of 120%. They're running it again right now. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Here's the simple model. Think of your savings as an ice cube sitting on your kitchen counter. Every month, you check on it. Looks the same size, feels solid. Your bank statement confirms it. $47,000. But what the statement doesn't show you is that the ice cube is melting, slowly, predictably, by design. The mass is shrinking even though the shape looks identical. That's inflation eroding purchasing power. And financial repression is the government quietly turning up the temperature in the room while telling you everything's fine. Let me show you the math that makes this unavoidable. The United States federal government currently owes $38.5 trillion. The debt to GDP ratio just hit 122%. Interest payments alone now exceed $950 billion per year. That's $2.6 billion every single day just to service existing debt, not pay it down, just to keep the lights on. The Congressional Budget Office projects that without major policy changes, this ratio climbs to 143% by 2030, higher than the post-World War II peak. Now you might be thinking, okay, debt's high, but governments can just cut spending or raise taxes, right? Let me walk you through why that's mathematically impossible. The federal budget breaks into two categories: mandatory spending, that's Social Security, Medicare, Medicaid, and interest on the debt. Then discretionary spending, that's defense, education, infrastructure, everything else. Mandatory spending already consumes roughly 70% of the entire federal budget. To close the deficit through spending cuts alone, you'd need to eliminate somewhere between 30 to 40% of Social Security benefits, or gut Medicare by half, or cut defense spending to levels not seen since before World War II. Show me the politician who runs on that platform and wins. I'll wait. Tax increases? To close the gap, you need to raise federal tax revenue by roughly 30 to 40%. The top marginal income tax rate would need to hit somewhere north of 60%. Corporate taxes would need to double, and that assumes economic activity doesn't contract when you pull that much capital out of the private sector, which it absolutely would, making the deficit worse. Neither cutting nor taxing is politically viable. So what's left? This is where it gets really interesting. Governments have three options when debt becomes unsolvable. Option 1, explicit default. Announce you're not paying back bondholders. Trigger immediate global financial chaos. Option 2, austerity so severe it causes a depression, political suicide, economic catastrophe. Option 3, the quiet option, the one they actually use. Financial repression. You don't default on the number, you default on the value. You make every interest payment on time. You repay every dollar of principal exactly as promised. But you engineer conditions where inflation runs at 7% while forcing savers and bondholders to accept yields of 3%. That negative 4% gap, that's wealth transfer. From you, the saver, to the government, the borrower. It's a tax that requires no congressional vote, no public hearing, no admission. Let me tell you a story. 1945, United States federal debt, $251 billion, debt to GDP ratio, 112%. The entire industrial capacity of the nation had been redirected toward war production for 4 years. Victory purchased on credit. The bill came due. Conventional wisdom said the US faced two options: slash spending by half and trigger mass unemployment, or explicitly default and destroy the dollar's credibility. They chose option 3. April 1942, the Federal Reserve made a commitment that defined American economic policy for 9 years. They agreed to peg Treasury yields at 0.3% for short-term bills, long-term bonds capped at 2.5%, period. If market participants tried to sell and push yields higher, the Fed would buy whatever quantity necessary to defend the peg. Monetary policy became completely subordinated to fiscal needs. Here's where the magic happens. Between June 1946 and June 1947, inflation hit 17.6%. The following year, 9.5%. Over the entire decade, from 1946 to 55, inflation averaged 4.2% annually. But remember, Treasury yields remain capped at 2.5%. Do the math. Investors holding bonds at 2.5% nominal yields, while inflation ran at 4.2%, experienced real returns of negative 1.7% per year, every year, for a decade. You received every promised interest payment. You got back every dollar of principal. And when you went to spend that money in 1956, your purchasing power had been gutted by 15 to 20% in real terms. The government made every payment, technically, no default. But the value? Silently confiscated through inflation. By 1955, the debt to GDP ratio plummeted from 109% to 31%, a decline of 78 percentage points in 10 years. Sounds miraculous. Responsible government paying down debt through fiscal discipline. Wrong. The National Bureau of Economic Research did the autopsy. The absolute level of federal debt barely declined. It fell from $241.9 billion in 46 to $214.3 billion in 49, then stabilized. The ratio fell not because government paid off debt, but because GDP grew faster than debt. And inflation accounted for nearly 40% of the entire decline in the debt to GDP ratio during this period. The government inflated its way out. Bondholders, ordinary Americans who bought war bonds, pension funds, insurance companies, retirees, paid the bill through negative real returns systematically imposed for a decade. Not coincidence. Deliberate policy architecture. Now, pattern recognition time. Same 4-stage cycle operating right now. Stage 1, unsustainable debt. Check. 38.5 trillion and climbing. Stage 2, central bank intervention to suppress yields. The Federal Reserve's balance sheet in December 2005 was $800 billion, representing 6% of GDP. By December 2025, 6.5 trillion, 21% of GDP, an 8-fold expansion. They don't call it yield curve control anymore. The euphemism is quantitative easing. The mechanics are identical. The Fed purchases massive quantities of Treasury securities, suppressing yields below levels that would prevail if the government had to compete for capital in free markets. When COVID hit in March 2020, the Fed bought 2.3 trillion in treasuries within 3 months. The 10-year Treasury yield, which had been 1.92% in December 2019, plummeted to 0.52% by August 2020. This wasn't market forces. This was policy intervention designed to cap government borrowing costs. Stage 3, inflation above yields. Between March 2021 and March 2022, US inflation averaged over 8%. During that same period, average yield on savings deposits remained below 0.5%. Negative real yields of 7.5%. The St. Louis Federal Reserve quantified the damage. American households holding demand, time, and savings deposits lost approximately $1.77 trillion in purchasing power during that single 12-month period. You didn't get a tax bill. No IRS notice arrived. but your wealth was confiscated through the mechanism of negative real interest rates. Stage 4, regulatory capture. This is the part that makes contemporary financial repression more insidious than the 1940s version. The regulatory architecture has been redesigned to trap your money in the system. Banking capital requirements now apply preferential treatment to government securities. A bank holding treasury bonds faces zero risk weighting for capital purposes. A bank extending a business loan faces higher risk weights, requiring the bank to hold more capital against the same loan amount. The result? Banks are systematically incentivized to buy treasuries instead of lending to businesses. Your deposits are channeled toward government financing, whether you consent or not. Pension funds face the same trap. Regulations require them to hold safe assets, defined as government bonds and highly rated securities. When yields are artificially suppressed, pension funds must choose between holding government bonds earning 2% while inflation runs at 5%, or violating regulatory requirements. They're trapped. Let me paint you a concrete picture. Meet David, 52 years old, mechanical engineer, spent 25 years saving diligently, has $150,000 in a high-yield savings account, currently paying 4.2% annual interest. Sounds responsible. Here's what actually happens. Year 1, he earns $6,300 in interest. Inflation runs at 3.8%. His real purchasing power increases by 0.4%, or $600. Not great, but positive. Year 2, the Fed cuts rates. His savings account now pays 3.1%. Inflation stays at 3.8%. He earns $4,650 in interest, but purchasing power declines by 0.7%. He loses $1,050 in real terms. Year 3, inflation ticks up to 4.5%. His account still pays 3.1%. He earns $4,650 in interest, loses 1.4% in purchasing power. That's $2,100 gone. Over 3 years, David earned $15,600 in nominal interest. His purchasing power declined by $2,100 after accounting for inflation. The ice cube melted. Now you might say, well, David should have invested in stocks or real estate. Absolutely correct. But here's the psychological trap. David was told his entire life that savings accounts are safe. That cash is king. That you need 6 months of expenses in liquid savings for emergencies. All true, to a point. But when real yields turn negative, holding cash becomes expensive. It's a hot potato. You're paying the government to slowly confiscate your wealth through inflation. And most people don't realize it until they're sitting at the kitchen table at age 67, wondering why retirement feels tighter than the math suggested it would. To be fair, some people will say the Fed is independent. They won't subordinate monetary policy to Treasury needs. Let me show you why that's naive. When COVID hit, did the Fed maintain independence and let markets set Treasury yields naturally? No. They purchased $2.3 trillion in treasuries in 3 months. When regional banks faced stress in March 2023, did the Fed maintain independence? No. They created emergency lending facilities within 48 hours. Former President Trump threatened in January 2025 to dismiss Federal Reserve Board members for policy reasons. When elected officials openly threaten central bankers, independence is already compromised. This isn't some grand conspiracy. It's incentive alignment. When a government owes 150% of its annual income, the central bank cannot maintain independence. The fiscal pressure becomes irresistible. Here's the comedic part. Imagine you're the Fed chair. You're sitting in your office. The Treasury Secretary calls. She says, listen, we need to issue $800 billion in new debt this quarter. If yields spike above 5%, interest costs become unsustainable, and we have a debt crisis. Can you help out? You have 2 choices. Say no, maintain your precious independence, watch a sovereign debt crisis unfold, get blamed for the resulting depression, or say yes, buy some bonds, suppress yields, kick the can down the road, retire with your reputation intact, and let the next guy deal with it. What do? Exactly. You buy the bonds every single time. Here's the pattern nobody talks about. Financial repression works through a wealth transfer mechanism that's completely invisible on your bank statement. The government borrows at 2%. Inflation runs at 5%. They're effectively paying back debt with dollars that are worth 3% less each year. You, the saver, are the counterparty. You're earning 2% nominal, losing 3% real. The government wins, you lose. It's a zero-sum transfer, and it's perfectly legal. Now, this is where most finance channels would tell you to panic, buy gold, move to another country, start a bunker. I'm not going to do that because panic is expensive and usually wrong. Instead, I'm going to give you 3 specific actions based on how financial repression actually operates. Not speculation, strategic allocation. First, eliminate long-duration nominal bonds from your portfolio. If you're holding 20-year treasuries yielding 4%, while inflation runs at 3 to 5%, you are the target. You are the wealth being transferred. Bonds will pay every promised dollar. Those dollars will buy progressively less. Shift to Treasury inflation-protected securities, TIPS. They explicitly adjust principal and coupon payments for inflation. If inflation runs at 5%, your TIPS principal increases by 5%. Real purchasing power preserved. TIPS don't protect you if real yields themselves are negative, but they eliminate the inflation erosion component. In an environment where the government is deliberately generating inflation to erode debt, TIPS are the asset class designed to neutralize that mechanism. Second, acquire real assets with pricing power. Equities representing businesses that can raise prices in line with or above inflation without losing customers. Companies that increase dividends annually. Real estate generating rental income adjustable for inflation. Commodities, precious metals. The pattern is simple. Shift from fixed nominal claims to real assets whose value adjusts with inflation. I've been running my own business for over 10 years. I've watched how pricing power actually works. The companies that survive inflationary environments are the ones that can pass costs to customers without breaking demand. Software subscriptions, healthcare, energy infrastructure, consumer staples. These sectors have pricing power. Your fixed rate bond does not. Third, and this is the contrarian play, consider fixed rate debt. Financial repression erodes the real value of debt just as surely as it erodes the real value of savings. If you borrow $500,000 at a fixed 3% mortgage rate and inflation runs at 5% annually, you're paying back that loan with depreciated dollars. The government uses inflation to liquidate its debt. You can use the same mechanism. Lock in long-term fixed-rate debt at artificially suppressed yields. Invest the proceeds in real assets or inflation-protected securities. Let inflation erode the real value of what you owe. In a financial repression environment, debtors win, creditors lose. Position yourself accordingly. I have multiple hundreds of thousands of dollars invested across these strategies. This isn't theory. It's how I actually allocate capital. I've spent a decade surrounded by accountants and fiscal lawyers who taught me one lesson above all others. Money flows toward incentives. Right now, the incentive structure punishes savers and rewards borrowers. The government needs inflation to outpace yields. That's the only way the debt math works. Your job is to position yourself on the winning side of that transfer. Let me give you the mathematical certainty nobody wants to admit. The Congressional Budget Office projects federal debt rising from 100% of GDP to over 150% within 3 decades. Interest costs will exceed 3.2% of GDP, higher than at any point in US history, except the immediate post-World War II period. Mandatory spending for Social Security, Medicare, and Medicaid will consume progressively larger shares of the budget as demographics age. There is no political pathway to fiscal consolidation. Cutting entitlements is electoral suicide. Raising taxes sufficiently is political impossibility. Economic growth above 3% sustained for decades is demographically implausible when the working age population is shrinking. That leaves one option: financial repression. Inflate the debt away, suppress yields below inflation, transfer wealth from savers to the government through negative real returns, sustained for years, possibly decades. The only question is intensity. Will they replicate the 1945 to 55 playbook with negative real yields of 1 to 2% sustained for a decade? Or Will fiscal pressures force more aggressive repression with negative real yields of 4 to 6%? Either way, the transfer is coming. The mechanism is already operational. Your savings, your pension, your fixed income portfolio, that's the collateral being liquidated to pay for a debt burden that cannot be serviced through conventional means. This isn't conspiracy. This is autopsy. Rome debased the denarius. Britain abandoned the gold standard in 1931. The United States ran financial repression from 1942 to 51. Every over-indebted empire in history follows the same pattern. It's mathematical, predictable, unavoidable. Here's what I actually do with this information. I keep minimal cash in savings, 3 months expenses, maximum. Everything else goes into tips, dividend growth equities, real estate, and a small allocation to commodities. I have a fixed rate mortgage at 2.75% that I will never pay off early because inflation is doing that work for me. I track real yields monthly. When the 10-year TIPS yield goes negative, that's a flashing red signal that financial repression is intensifying. I adjust allocations accordingly. This is systems thinking, understanding incentives, positioning capital where the current flows, not where you wish it flowed. Lazy investing built more fortune than crypto memes. The people who got rich in the last century weren't the ones chasing hot stocks or timing markets. They were the ones who understood the macro game, positioned accordingly, and let compounding do the work. Right now, the macro game is financial repression. The government needs inflation above yields. They need your purchasing power to erode. They need savers to subsidize borrowers. You can fight that reality and lose, or you can accept it and position yourself correctly. The ice cube is melting. The question is whether you're going to keep checking your bank statement, seeing the same number, feeling safe, while the real value disappears. Or whether you're going to move your wealth into assets that grow with inflation, preserve purchasing power, and put you on the right side of the transfer. Your move.